So last year you published your second book called Mastering the Market Cycle. Why was it important for you to communicate to investors or to the public how to identify where we are in the market cycle?
Well, what do active investors do? In my opinion, everything we do falls under one of two categories: either asset selection, which is trying to own more of the things that will do well and less of the things that will do poorly, and cycle positioning, which is trying to have more invested more aggressively when the odds are in your favor, and less invested more defensively when the odds are against you. So I don't think you can do the latter based on predictions of what's going to happen tomorrow or next year. I think you can do it on the basis of understanding where we are in the cycle.
So this leads to the obvious question. You've been a professional investor for something like 50 years. You are now a billionaire investor because of your success. Where do you think we are in this current market cycle?
I'm firmly convinced we're in the 8th inning. Of course, the problem is I've been saying that for several years. And then a year or so ago, I realized that this isn't baseball, meaning we don't know how many innings there are. In baseball, if you say we're in the 8th inning, it means something because a routine game is 9. But in investing, it could be 9 or 11 or 13. We don't know. But the expression 8th inning, what it means is I think we're closer to the end than to the beginning. I think the easy money's been made. And I think the most important single decision that an investor can make in the intermediate term is this the time for offense or defense? And the statement that we're in the 8th inning suggests that this is the time for defense.
So you've said publicly that Oaktree has been quite defensive in its stance, and yet you've also said Oaktree has remained fully invested with its investor capital. So where have you found those most compelling opportunities to deploy money in either by geography or by sector or by asset class right now?
Well, you know, Devin, we don't decide the diversification of our assets. People come to us and they say, here's money for US, here's money for Asia, for high yield bonds, for leveraged loans, for distressed debt, for real estate. So that's not a choice we make. But what we have done is we've tried to be fully invested, as you say, but to maintain an unusually high level of caution. Now, it's challenging to be cautious in an uncautious environment where many other investors aren't cautious, but we're putting the emphasis there. By the way, there are no bargains in the world. There's nothing being given away. There's nothing really that you can buy below intrinsic value. So what we're looking for is the least worst, if you will, the least overvalued. And I think you can find those in private credit, real estate, I would say outside the big cities, emerging markets, things like that. Now, most people say the same thing. So I think that the key is to go into those things and find the better bargains.
Oaktree has been expanding both by headcount and now by assets in Asia quite a bit over the past 1 to 2 years. Why is that?
I think Asia is a big part of the future. I think that there's a very, very good chance that Asia will grow faster than the US, faster than Europe, in the decade or two ahead. So it's not a statement about what I think is going to happen in the market next year, but I think that the opportunities are there and you have to follow them. In particular, we are largely a credit investor. If you went back 10, 12 years ago, the Asian economies were not debt-driven economies.
Right.
Debt has become much more important over there, and so we think this is a time for us to increase our emphasis.